Hi, Warriors. How's everyone doing today? Got through the week, right, AJ? Mike, AJ, Alexander. Hi, Steve. Kman, TGIF, Bro, Hugo, Cal Barnum. Welcome to Face. Kurt Bell. Welcome to Face. Timothy Jabin. Welcome to Face. Okay. So, who had a good week in this chop fest?
Oh, I wish I could say I did.
Okay. I mean, can we get a market to go in the same direction 2 days in a row?
For more, for yeah, right, for more than a couple hours, it seems like.
Yeah, yeah, not much follow through to yesterday's weakness in the dollar, but I still think you have to stay with what happened yesterday more than what this pullback is here.
Yeah,
Because
I
if we,
think the overall theme of being short dollars is really more of a sticky one. But as you know, Ryan and Kman and all of us have been talking about, it's the end of the month. There should be
yeah,
some
dollar buying,
sh dollar. Well, there was dollar buying at corporate month end, which was on Wednesday, which we did
yeah.
see, and but I don't know if yesterday was an unwind of all the news or there was some probably dollar selling that's supposed to happen anyway. But we do have some month end dollar selling supposed to happen.
Was
Uh,
there some new tariff news? I was just browsing around and something about China in the last 12
you
hours
have to
or
ask
anything?
K-Man may know. I don't I didn't see anything, but I've been kind of scurrying around getting ready for I had to actually take a shower today. So
Yeah, because you're gonna be on camera.
End of the month.
Just end of the month.
Yeah,
Anyway, I
it's the end
just
of the month shower. Good morning, everybody.
yeah, it
good
is.
morning came in.
Yeah, that's
Oh,
exactly.
the end is
You nailed it, and you got me. Yes, end of the month shower.
Keg, gold is looks like it's rolling over. I know that this was shallow and
Mm.
bulls are saying this was five. Um we take out 240. That would open the door, I think, for 3,000.
Yeah, it could. Just one thing, and I've already said it on the various shows. Don't forget that the metals also have month-end flows because Reuters or WMR found it funny a few months ago to introduce fixing rates for metals as well. So we could see a bit of strange stuff going on there as well towards 4 p.m. our time or around there, so in about 3 hours or so. But yeah, it is. It's not holding the rallies for now, but it's still in a bit of a triangle there.
Hey,
Okay.
guys, can I know
Yeah,
you're
go ahead. I
talking
know you
about
have to
crude.
go.
Go go
No,
go!
you're talking about crude and that headline about OPEC. They might discuss an output larger than 411,000 barrels per day for July meeting on Saturday. That's what some sources say, and that's why crude has slipped back down towards that support.
Yeah, I tell you, yeah, that'll probably look like a breakdown under $60,
Oh
like a
yeah,
like a rectangle, $4 range about
yeah, we've been
$3
60 to $64. That's exactly right.
for like over a month. Okay, so I know you have to go in
I
about
do.
10 minutes.
Yeah, let
Why don't you why don't you
let
take
let
the screen?
Yeah, I'll do that. I'll chat real quick just about some things that are happening. By the way, if you guys are Forex Analytix users, if you go over left to the news flow right here, you have our friends at PIQ. We've integrated more with them. You can actually pop out a news source and get a lot of these major news that have happened overnight right here. So just you have that next to your live squawk feed. So just a little heads up about that. Anyway, talking about what's happening in currencies, though, we do have the end of month, end of quarter, whatever. The thing that I've noticed is obviously we had this big bounce in the euro. This is over 170 pip bounce. We've actually hit the 38% retracement this morning and we're sitting on, we're just sitting above 113.20. So that's important because now we know where the breakdown point is. Like, let's say dollar buying or dollar selling doesn't manifest and you start to see the euro come down, which is entirely possible. We've seen a lot of estimates not happen. Oh, we're supposed to see dollar selling come through, and then we end up getting the opposite. Because maybe it was all done yesterday, the majority of it. Well, if we start breaking through this support, we're going to see, 112.80 probably pretty quickly. We're going to end up unwinding this whole move, especially given the fact that we actually reversed at this descending trend line. I want to, you can see Kyle, he's listening in. He said hello to you this morning, Dale. Kyle was in the chat room and he pointed out this descending trend line yesterday when we were approaching it. And we started updating the Forex Analytix charts as a result intraday on the basic technical analysis when because Kyle mentioned it. And this is one thing about being in a community. When you're in a community and you're in a community of traders, we see you guys see things that we don't sometimes, and that's totally common. I get a lot of my trade ideas directly from our community as they get from us, whether it's Kman, myself, Ryan, whoever it is. So this trend line actually capped. It capped the euro, and we even actually hit it in Asian trade and reversed, which was interesting because we were noting, oh, it's almost there, and then in Asia we actually hit it. So that's an important resistance for today, because in the event that we break through 114 in the euro today, let's say it's end of month flows, let's say we have a weaker PCE, which, as Ryan and Kman were talking about on the flow show today, the PCE has already been tipped by Powell to come in at 2.2%. Is that what he said, Kman? 2.2.
And last two numbers he was spot on. So let's have faith.
Yeah. So and if it is, if it is spot on, then we might not get much of a movement. But the flip side is, anything outside of that, I think forecasts were. I saw some forecasts looking for a tick higher at 2.3. So if that's not the case, and maybe we come in line, you might see that dollar selling actually take place because the market was already anticipating, a slight beat. And so without that might be the catalyst that starts kicking off some of this end of month moves in the dollar. We were also in the chat room. We were talking about Michael Weissman, which he's listening in right now. He said good morning to you as well this morning, Dale. We were talking about the diamond formation that was forming in sterling. This is an intraday formation. These are really rare, about as rare as diamonds are, I guess, in real life. Diamond formations are not something, and we were having this discussion. I think it's worth talking about. We were having this formation develop, and he's like, "Yeah, I don't hear you talk about the diamond formation." It's like because they're kind of rare. But when you see them, they usually exit the way they came in. So, and that's like it's the same concept. If you're looking at like you're looking at a wedge, and you're like, oh, that's a bullish wedge. Well, more times than not, it breaks higher than lower, and that's the same thing with a diamond formation. Diamond formation says, it comes in one direction, it should go out the same direction. So, in other words, it's more of a reversal pattern. Typically speaking, that doesn't mean it has to be that way, but you got your 60-40 probability that it does. So that's just a little heads up about that. Again, they're not formations that I see all the time, but they're formations worth noting. There was something else that I wanted to mention before I go for the session, and now I can't. Oh shit! What are you guys seeing this? We are seeing moves right now, and I don't know why. Stocks are coming under pressure. Here's a 1 second chart. Sorry, I didn't want to do a 1 second chart of the euro. Here's a 1 minute chart of the euro. The euro's moving around or that's sterling. Here's the euro. You can see the euro just spiked up. Stocks just moved lower. What do you see? Do you see anything, Kman?
No, seeing nor hearing. Maybe just
They rallied.
Truth Social. 2 weeks ago, China was in a grave economic danger. The very high tariffs I set made it to virtually impossible for China to trade into the United States marketplace, which is by far number one in the world. We went into effect cold turkey with China, and it was devastating for them. So, this is the taco trade. You guys understand that. This is why he's saying this stuff. Many factories have closed, and there was, put it mildly, civil unrest. I saw that this was happening and didn't like it. For them, not for us. I made a fast deal with China in order to save them from what I thought was going to be a bad situation. I didn't want to see that happen because of this deal. Everybody quickly stabilized and China got back to business as usual. Everybody was happy. That is good news. The bad news is China, perhaps not surprisingly to some, has totally violated its agreement with the US. So much for being Mr. Nice Guy. So, in other words, he's defending himself for the taco trade because the Trumpo's chicken's out, right? He's defending himself. And now he's going to come back at China. So watch the Euro Aussie's going to rip. Watch the S&P is going to sell off, which it is. Dollar yen is getting crushed right now, and that's Mr. Taco Guy he's gone. He's out. No more taco. No more taco except on Tuesdays. So that's it for me. Dale, it's all you, buddy.
Oh, I can't follow that up.
Come on.
Go on.
I gotta jump on. I gotta jump on another show. You got
Okay, well, jump out the window.
it. I'm going. I live
It
on the
sounds
first.
like
my,
it.
my office is on the first floor. I can't. I don't.
Well, you could still
I'll
go.
twist an ankle.
All right. Have a great show. Break a leg.
Thanks. See you guys.
So it's me and you, Kay.
And we got Steve as well.
Oh, yes. Hi, Steve. Steve, you want to talk?
Hey Dale, good morning.
How are you? How are you?
Good. How have you been?
Pretty good, buddy. So, what do you think about the board today? And we're definitely getting pressure in the S&Ps. The dollar. Do you think yesterday's action?
Dale?
Has totally violated its agreement with U.S. gas.
Sorry, Kman, say again.
Do you
What
want
do you
to
submit?
share your screen, Dale? Because we just see our
Yeah. Take the screen, Dale.
Okay. All right. There you go. Okay. So, do you think yesterday's action in the dollar was decisive when we opened up here on, the tariffs being delayed, and then we sold off? Or is there still a possibility this is A and this is B, and then we get a C, and then it fails? I'm conflicted.
It is technically possible to do what you said, but I think that since technically nothing has changed during the past few days, despite the small rebound we had, despite yesterday's reversal, I think that the simplest and easiest way to approach this is that the dollar's path of least resistance remains lower.
Down, yeah.
Yes, exactly.
Okay.
So I think sometimes, we as traders overcomplicate things. And in this case, I think simplification of the facts is that it's more likely to resume lower than anything else. At least that should be our point of view, as long as we still trade below the broken corrective channel. If I am to put a level roughly, let's say, as long as we trade below 101 in the DXY, we should keep looking lower.
Gold trying to come out of here after being 30 lower, putting in a higher low.
Gold, a nice intraday reversal yesterday, but it's still holding within the descending channel that has defined the correction from the all-time highs. If you draw a trend line from
up here.
Yeah, exactly.
Yeah, I can visualize it.
Yeah. So we're very, very close to resistance, which means that, from a risk-reward perspective, obviously it's not a smart idea being long here. But nonetheless, we end up breaking higher, which is a likely scenario. If I am to put a level to that, I would say, let's say roughly 33, 35. Then, in my opinion, we're on our way to new highs.
New highs, yeah.
Yeah.
There are a lot of calls for that. I mean, if we get one more messy sell-off in in S&Ps. That could be behind it. I think that what could be behind it is, I
The
keep waiting for
indices are not doing bad.
anything.
Yeah, but not doing anything
It's
after
good
this
kind of
strong
rally.
recovery
Yeah.
is definitely not a signal to be bearish, right? I'm not saying that we can't turn lower from here. Of course we can. But for the time being, we need more technical evidence to assume that's the case.
Look how messy the silver chart is. It's almost like,
Yes, it is.
have you
But if you
ever
notice the recent price action,
ever see a chart with more wicks
yeah,
than
you're
this?
absolutely right. But if you
That's
notice the
weird.
recent price action, let's say during the past
2
roughly 10
weeks.
days, is a nice
Yeah.
triangle, right?
Yeah, I see what you're saying.
Yeah.
Yeah.
But
So
overall, it's a lot more messy, a lot less clean than the
what
gold
this
chart.
tells me? It's a liquidity issue when you're having spikes like this.
I don't think
Big
there is a
bids.
liquidity issue in silver, but we do know that metal trading tends to be erratic. There are indeed some times of the day that liquidity is lower, and usually, from experience, which is weird, that is when we get weird sell-offs.
All right. Um, I wanted to ask you about rates. You have a view on the 10-year? I had this like little head and shoulders. Was this it? Or is there another run towards 470? Do you
Sorry,
have a
say
view
again,
on?
Dale.
Do you think that this pullback is it, and we're on our way back up for one more high, or are we breaking down and
I
heading towards 4.25?
I think
Coin
that
toss trading.
lower
Rates.
rates, yes, are more likely to rally than longer term. So the further we go in the yield curve, the
Yeah.
less likely
So
it is to see a bigger rally.
you're
I
looking
don't
for a
think, for example, it's going to be
steepening.
easy for the 10-year to reclaim the 5% high we got.
Okay. All right.
And if it does, the conditions under which this might happen are not going to be pretty. I can tell you that much.
Here's the most hated market in the world. I mean, even your hairstylist is bearish bonds. So and the positioning is so, I've never seen a market with as much extreme positioning on the short side. It's like they're positioned for a sovereign debt crisis. What do you think? Was this a bottom? Because it would have been classic. It was on the Moody's downgrade in TLT.
It's technically it's too early to call that a bottom because if you notice, even the rebound from these lows is really lacking momentum, right?
Yeah.
I mean, yes, the first 3-4 days had some momentum, but as you notice, momentum keeps slowing following that. So I'm not that convinced yet. But I do think that the downside isn't going to be easy to come, right? So I think that longer maturities in US treasuries are for the time being more or less boxed in.
I think the
Somewhat.
Fed was in buying some. I thought I saw a report that they came in and bought some. They've been doing some kind of
twist.
quiet QE by buying bonds.
I mean, I wouldn't be that much surprised. It's not a bad idea to. I'm actually going to have I'm going to have a look in the Fed's balance sheet following the webinar and look into what they've been recently doing. It's a good idea to have a look at it.
Yeah, I think they started here in the crash when, the market was down and the bonds were getting no flight to quality, and they turned it, and this is when I think Paul said, we will provide liquidity. So, you know, the bond market was in a panic with the last leg down in risk. So, you know, they were also being sold off as, you know, risk on, risk off. So I think they might be in there, Steve. Let us know what you find out when you dig in. I'm sorry I gave you a homework assignment for the weekend,
No,
but
this is,
be good to know.
this is good to know, and I'll pleasantly do it.
Kay, I was wondering, I have to go
Yeah.
look for my guest. We have a little conflict or misunderstanding
Hmm.
about the time. So if you could take the screen
Oh,
and you and Steve talk, I'm going to go be Forex guest hunter for a couple minutes.
what do we talk about?
What do you talk about? Talk
I was,
about,
I was asking Steve. I was asking Steve. What do we talk about, Steve?
okay.
What do you mean, Kay?
So I say, Dale told me to take the screen, and I asked you, what are we going to talk about? No, okay.
That's your thing to decide
Yeah.
what
Hey,
you want to talk about.
Kay,
Just a couple of
show
my spaghetti shots.
no, about ask him how Uber looks.
Oh, no. I'm not going there. I'm not going there.
Get out of my you don't like my Uber short? Does it?
Too complicated for me.
Oh, okay.
All right. Your guest says that he's there, so you can invite him. Apparently. Okay. So just a couple of shorter term things, if I may. We have seen a few developments earlier this week, and there were some interesting levels that got hit on the dollar. We've already been talking about that, the euro dollar cable, but a couple of other ones as well. And we are the last day of the month. I just want to show, and I know it's a messy one, but I just want to show in case there would be some end of month stuff and the cable would decide to go on a run. Even if we hit that high that we hit last month, I still think that there is a big hurdle to overcome, and that's going to be in the 137s for me. Okay, that's more the longer term. I'm still my overall bias hasn't changed. I'm still like pretty bearish dollars, but we have to pay a little attention to the bigger levels that are starting to show up on the horizon. Okay, and so 136 is one obviously on the cable, but then don't look besides these 137s, okay? Because I think this is still going to be a big level for further debates, all right? In the meantime, short term, I'm even going to go on a shorter one. We are holding those intraday supports, which is still, I think, supportive for what is happening right now. And we are seeing that on a number of pairs, and I'm going to move on to Aussie, for instance. We're seeing that we are in this like relatively short-term channel, and we are holding those supports. Now, I think, and since we are at month end again, that there may be a bit of a jump here, but for the commodity currencies or the antipodians who are linked relatively close to what's happening in the commodity environment, we also need to notice, okay, we had this spike here on the dollar sell-off, but we have to notice that the spikes, especially, I would say in Aussie, tend to be short-lived. So I don't know, and then I'm going to bring Steve back into play. Commodities, Steve, what do you think about them? Are they having any impetus to go higher, which then would drag stuff like the Aussie higher? Or are we in a phase where we just don't know, or they are at risk of going down? What do you reckon?
I think we're at a phase of I would go with the don't know, because I
Yeah.
think that commodities are currently being pulled in two different directions.
Mm-hmm.
Direction number one is inflation, which remains extremely sticky, right?
Yeah.
In many places, even with a tendency to go higher again. But On the other hand, we have worries about growth,
Yeah,
which can pull them in the exact opposite direction.
yeah, absolutely.
So I think it's still a stalemate, and we need to see which direction is going to
Yeah,
win.
yeah, and that's why I reckon as well that even after we have seen some relatively positive moves here, which I would qualify rather dollar moves than really Aussie
Yes.
moves, and then
Yes.
I'm talking specifically about this Aussie, which is quite related to commodities because those commodities have issues to find really bid for longer. I think the Aussie will probably be in the same camp. So for the traders who are watching this is something that we talk about quite often, is those correlations between currencies related to various instruments. Some of these moves here, and especially the lack of conviction and the lack of being able to hold those rallies, will have to do with commodities. So that's why I'm always saying to the traders, watch the reason why something is moving. And we are seeing relatively similar picture, although I would argue after the RBNZ not giving us or not giving the market
Yeah,
anyway.
Kiwi, same
Sorry,
deal. Yeah, the
Kiwi, same
Kiwi,
deal.
same deal. They seem to be really stuck in place, aren't they?
Exactly. Exactly. And I would argue it's looking slightly more positive than the Aussie after the RBNZ. But again,
Yeah,
yeah,
but in any case,
yeah,
if they go, they'll both go.
yeah. And therefore, and we are not that far, it's about 1% from where we are now. I would say, like, if they have to go, okay, the Aussie is probably 65, 65 and a half somewhere, but look at this Kiwi level here going forward, and especially maybe next month, because we are at the end of the month now. Whatever happens at the end of the month here is to be classified in the short term bucket, right? There's a bit of resistance yesterday. We saw that as well around 59.90. But if really we need to, the market needs to sell a few dollars, don't be surprised if it goes for a walk. But once the week ends and we start a new month, next Monday, watch this 60, 30, 40, because this is going to be really the gateway to go higher. But for as long as the gate remains closed, which may be also due to those commodities and other stuff going on, not really taking off as well, this gate is going to remain locked, okay? And so this is a very, very big level. It's really the condition for Kiwi to continue to push higher, in my opinion. And for as long as we don't get it, it's going to be tough to really stay long for longer. And then we will have to just stick into that range, go up and down, but just don't expect too much for as long as this is not really getting unlocked, okay?
If you notice, even copper, for example, is in the camp of
Yeah, I
undecided.
mean, that thing is completely stuck, right?
Yeah.
Excuse me, guys. Danny, will you please accept being promoted to a panelist?
Okay.
And Kay, you want to get set up? Maybe you could do it, or Steve, for the PCE for the number
Oh,
with data flash.
hang on.
It's 2 minutes away. You have time.
Yeah, but I'm just going to put it there. Where's the data flash?
It's a separate box on your.
No, here, no. No, that's not the one.
Yeah, we have Canadian.
Before the release, stand by.
In
Where
1
is
minute,
that?
Canadian GDP,
I usually don't use this one.
USPC price index.
Can I just go and go put another page on there? Because we will see all the data coming out on here as well.
Okay.
You see this one?
Yes, we've
Okay,
got
we
it.
will have all of them there. I'll just put it to the side for now, and I'll. Oh, it's 30 seconds away. I just wanted to show quickly this triangle in gold, okay? Whatever happens over month end, guys, watch what's going on after month end, okay? We can go up and down, up and down, up and down, but to me there are quite big levels, and one really box that I'm watching here is just up in those 33, 65,
10 seconds for
85.
data.
Yeah, okay, I'm bringing it back. Here we go. And we have
Canadian GDP coming at 0.1 positive versus
yeah,
minus
a little better,
0.2.
but I don't hear the
Canadian GDP annualized pulls
personal
back to
income not too
2.2.
bad.
USPC price index pulls back to 2.1 versus 2.3.
Oh my God, Powell was wrong. He said 2.2.
USPCE price index.
So
I don't think
no massive moves off these
No,
numbers.
The
no,
core is
no.
pulling back to 2.5 from 2.6. I mean, the data didn't come as expected, but on the other hand, it's not that they're far away.
income not too bad. That is to be noted in April. But for the rest, I say move on.
US goods trade balance improves substantially from minus 162 billion to minus 87.
See, it's working already.
Yeah, but the thing is, no, but you know what? This is like they front ran all those potential tariffs massively the months before, right? So now we are coming back actually to levels where we were before the whole tariff.
That is true. The numbers are distorted from initial front buying because of expectations, and so the numbers will be distorted for a few months until the whole situation with tariffs settles. A lot of decisions are being made preemptively.
Yeah, exactly.
Anyway, I don't think we've traded through a more distorted time in my career.
And they're definitely weird times.
It's his most distorted.
Yeah, I mean, the thing is really, if you look at it, we're 5 years already since the pandemic and distorted markets, right? Where it's difficult to have a view for more than the next few days or weeks, because everything is changing. Right, Dale, I'm looking at
In
the
any
clock.
case, we're not seeing any big follow through.
See, Danny, you didn't miss anything.
Mhm.
I have
To the
Danny
data,
Diane
so
with us.
yeah, so you might as
Really,
well go
the
with
thing
your
that stands
interview,
out to me, Dale,
Dale.
the thing that stands out to me is the income numbers are just huge. The personal income numbers. That's
All right,
massive.
well,
I mean, that's a
all right,
9.6% rate.
all right. Let me thank Kman and Steve for being with us today, doing the numbers. And guys, this is Danny Diane. He's a global macro volatility portfolio manager. What a mouthful, man. And I've talked to Danny before. He's got a nice following and does a lot of great fundamental work and prepared something for us today. So, what's your initial reaction to the numbers, Danny?
Yeah, the trade balance is really interesting because despite what everyone was saying, the front running was mostly in pharma products. And so if that's fallen off, there really hasn't been that much front running. And so big picture, that means there's not going to be a huge amount of inventory that are not subject to tariffs, prior to tariffs kicking in. So that's going to be the story in the coming months, but GDP should bounce really, really strongly from that trade data. But it is noise ultimately. But the most important thing to me, core PCE was telegraphed. I never even find it interesting because we know the number pretty much after CPI and PPI. But personal income growing at 0.8%. I don't know how you expect this economy to slow if they're growing at a 9.6% annualized rate, their incomes. That's just exceptional. And so I don't know where this reacceleration is coming from because we didn't see like a blow up jobs number, but this is very, very strong. That to me is the most telling thing from this data.
Okay, so I was going to get to what you thought yields were doing. I know you were in negative long bonds with me, and we had that Moody's downgrade, and it put in a temporary low, classic, by the fact. And I'm wondering where your head's at now with the 10-year yield and long bond. Should we still be selling rallies, especially because we're showing this economic strength of consumers are going to have more spend because income's growing?
Yeah, I'm very bearish bonds. I think we are going well above 5%, but I don't think that's right away. I think it's going to take months. I'm talking the 10-year. I think the 30-year will head to 5.5, plus. But I think what's been missed by a lot of people is that the 2-year has moved up. The SOFR curve has moved up as well. It's not just the long end of the curve that's moved up. In fact, if you look at like SOFR Z5, December 25, or Z6, they've moved up as much as the 10-year over the month of May. So I think the story is there's better growth and there's better inflation. But let me show you, what I had prepared here that will kind of make those cases. So I put a chart deck. I like to do this. First of all, I'm exhausted from this tariff stuff. I think it's just every day something new. I think we're getting tariff fatigue. That's the new term that I'm coming up with for it. But the latest news was obviously this legal challenge, and you can kind of see what's taken out is all this IEEPA that takes the tariff rate, down to something like a 6% effective tariff rate. But nobody believes that that's the end of the story. There's a legal challenge for it, and then he can use the 301s if he needs to. It'll just take longer to implement. This story is not going away, but I'm frankly very tired of it, as I'm sure most people are. But I think that the interesting thing is, a lot of people are still remain bearish equities, but not recognizing that as uncertainty came down, the market reflexively went up. And you can kind of see that here with uncertainty, inverted. But as uncertainty, went back down, you get financial conditions easing that supports the economy. We had the fastest fall in the VIX ever from a peak above 40.
Amazing. Yeah.
It was pretty incredible. And so what the markets are telling you is, this is almost like an exogenous event, like a 1998 or Silicon Valley Bank. And as soon as they took the temperature down, the situation has improved. Now, that being said, uncertainty is because of what we just went through over here, what we went over, is still going to be more elevated than we were, January 20th. So we're in this kind of uncomfortable situation where we're much better than April 2nd, but we're also much worse than January 20th. And it kind of puts you in a weird dynamic there from that. But as you saw reduced uncertainty, the economic data has improved like magic. Everyone was talking about the surveys were showing us Armageddon type of outcomes. That's immediately improved. We had the strongest month of consumer confidence since 2009. I think it's the temperature went down, the market went up, everything has improved, as a result of that. It really was a sentiment, story, and it's a sentiment story on the way up. Retail, though, is the one driving the equity market.
Does that bother you? So that's a big bother to me.
Normally, yes, but I think they may have gotten this right the way that the institutions have not this time around. But we'll see. In general, they're the ones holding the bag, right? But from the way I'm looking at it is, I don't see material economic weakness. I do think that we will get a big inflation surge from these tariffs. But I think now that they've taken the uncertainty to more, lower levels, still elevated, but lower levels, I don't think that we have like an imminent, collapse into a recession dynamic. And if that's the case, then those dips, you typically want to buy them. A 20% correction in a month, you typically want to buy that if it's a non-recession. And so,
did you buy that break to 4,800, Danny? Because I actually had that number as a target, 4,800. Did you buy that? Did you buy the market down there at 4,800? S&P.
I bought in around there. So the week after, so first of all, when Liberation Day, that whole week and the bond market was blowing up, my better play was selling vol. So selling like VIX futures was a clean, easy trade because I knew that I could warehouse that Now, it's not for everyone, but I could warehouse that, and I knew that over time we were not going to stay at a 50 VIX. You know, I thought I could.
Where's your warehouse, buddy?
Look, when you're
All
trading
right.
personal capital, you can be a
Yeah,
little bit more, you know, liberal about these things and say, I have a,
I
you know,
agree.
a time horizon that is beyond what an institutional investor can deal with. In an institutional setting, that's a very difficult trade. But once that played out, yeah, I did buy the market. So not at the absolute bottom of, 4,600 or so, but I did get long, you know, recognizing that every incremental news flow we were getting was taking the temperature down.
Yeah.
Now, I think this chart here on the left is fascinating because even though I'm saying retail is driving the market, I mean, how aggressive they are is astronomical. You know, when you look at this was the downgrade day. This was Moody's downgrade day. You know, we were down trading pre-market, you know, 1.5%, 1.7%.
And they
They
were
come in
buying.
like crazy, the strongest buying in the morning session, you know,
In years.
as
Ever.
long as they've tracked retail flows. And then the amazing thing is this is if you look at the, you know, this is futures, then normally positioning follows price. And you can see that positioning has not followed price. So hedge funds, institutions have lagged behind. If the market doesn't correct from here, they're very underweight and they will have to chase. So I'm
That,
more worried
so
about
that's how you get a melt up. That's how you get a melt
a
up.
99 style melt up is like the tail risk that I think is worth playing for in option space, of course. You know, don't get over your skis, but I think that is the trade that I'm playing for is the melt up. I think too many people are still looking for the bear move for us to get a material bear move at this point.
Okay.
You know, from here. Even though I understand the arguments, you know, valuations have gotten extended again. You know, the bigger thing from a macro perspective that we have to think about is the deficit is out of control. You know, so here's, you know, the trajectory that we're probably looking at from the independent, you know, Committee for Responsible Budget. This was from Piper Sandler, and the way they structured it is that we get fiscal impulse positive during Trump's term, and then the so-called spending cuts are left for the next president. And you know, if you know anything about, you know, DC, these are probably not going to happen, right? In any meaningful form. The next president will come in and is not going to want, you know, 4 years of fiscal tightening. So likely the deficit is just going to continue to be a problem until the bond market, you know, makes clear that we've reached a point of no return. And I think that will happen.
What's that day like? What's that day like, and how far away is that? How long are we going to be given? I don't think we're going to have the same latitude to continue this behavior as we've had. Are we approaching what could be some type of end game here, Danny, in debt? And are we headed into a sovereign debt crisis? Is that your view?
I think we are over the next few years if we don't deal with it now, because Social Security by between 28 and 32, no one really knows the exact date, will go into deficit. And to plug that hole is easily another 5-6 trillion. And so when the market starts to realize not only are they crazy with the spending now, it's going to get materially worse. The 30-year could really go to like 6%. And I think, like I said earlier, you know, the front end of the curve has moved up alongside the back end of the curve. So even though everyone's like term premium and duration, I think this has been a growth and inflation reassessment post, you know, what do we call it? Capitulation, you know, from, or the taco move or whatever. I think that's the first move. But if we get term premium go 100 bips from here, which to me seems reasonable, and I'll show you some charts in a second on that. Then I think you know, we're gonna have a serious problem, you know, with the fiscal deficit. So I think it's coming. I think it's building, and I think we're seeing rallies getting shallower and shallower. But at the same time, you know, we haven't really cracked yet. You know, we'll see if we crack.
Is the Fed in, is
You
the
know,
Fed in quietly, Danny? Because they came out a few weeks
no,
ago. You don't think they're buying
no, they're
any
not.
bonds?
No, I mean they're buying because they're doing less QT. So
Okay.
because QT has been taken down on the treasury side to 5 billion a month,
Yeah.
that means they have 30, 40 billion a month of reinvestments that they buy. So
Okay.
they do buy that. So, you know, that is a form of QE. It's very small, but it's not them actively supporting the bond market the way some people are talking about. You know, that is
Okay.
not what's happening. They're not doing yield curve control or anything like that. In
Okay.
fact, I think if they do that, we're screwed. If they do that, watch the dollar collapse. And the dollar is the key to everything. I heard you very focused on it on, you know, earlier. I have a couple things and we'll talk about it in a sec. But I think the dollar is the most important market to pay attention to by far. And I
Yeah.
think it drives the bond market in a way. But
I
before we
agree.
get to that, I kind of wanted to just say, you know, they have the new mantra is run it hot. Now we'll see if they're successful at it. But the new mantra is run it hot. They're saying we're going to grow out of the debt. And their two ways of doing it is one, you know, deficit, you know, to stimulate the economy. Hopefully that gets, you know, the economy to grow fast, but also deregulation of the banking system, which we still don't know fully what they're going to do. But if they do get this, you can see, look, this is money supply growth. It's growing around 5% a year, which is very low. If this were to grow more like 8 to 10% a year, the economy is taking off. And the reason they think that it's too low is the regulations have, you know, affected how much banks lend relative to their deposits. So that's the light line here, the loan to deposit ratio going back, you know, multiple decades. As you can see, prior to the GFC, you know, this was around 90 to 100%, you know, sort of ratio. Their deposits, you know, would grow, they would lend, you
Lend it
know,
out. Yeah.
to households, to businesses, and so on and so forth. GFC collapsed this to a 70% range, and then post 2020, additional Biden regs have collapsed this even further. If they can get this up to healthier levels like 80%, then again, you're going to see money supply start growing fast, and you're going to see the economy take off. Maybe then we can talk about outgrowing, you know, the debt. We need to grow faster than interest rates, you know, levels.
Yeah.
But it remains to be seen, you know, how they're going to accomplish this. To me, the real story from the capitulation or the taco whatever you know dynamic is that, you know, we clipped the left tail of growth, meaning the recession is, I think, off the table. We could still have some slowing, but I think recession is off the table due to them, you know, capitulating. Clearly, they met their constraints. The constraints were the market action. But we have not clipped the inflation tail. And I think the inflation tail is coming. It's hard to say exactly when, but if you look at all the forward-looking indicators, you know, here's the S&P PMIs signals, you know, we're going to get 5% inflation. If you look at, you know, regional PMIs, you can see the Philly Fed, it went before CPI in 2021, and then it went down before CPI in 2021, and it's surging again. So you know,
Yeah.
it's a leading indicator for inflation, and we see
Yeah.
this. And you know, these are the business surveys, and then you get to the household surveys. Inflation expectations are completely unanchored. This is the average long-term inflation expectation in the University of Michigan series, 9%. I mean, I don't think we should be like looking at this number and saying we're getting 9% inflation. I don't think we're supposed to take it literally. But the fact that they're saying this while core PCE is printing 2.5 tells you that inflation expectations are unanchored. You know, they're expecting materially higher inflation. I love this chart. A friend on Twitter put it together. It standardizes into Z-score terms the inflation expectations series and what that means for actual inflation with a 2-month lag. And you can see that we should get, based on inflation expectations, a 2 standard deviation move in CPI ahead. You know, it doesn't mean a 2% move. but it means a 2 standard deviation move. And so, you know, that's pretty big for CPI, which has been pretty, you know, static and flat, sticky at too high a level, but flat for 2 years at like sort of a mid threes range. If we're going to get a 2 standard deviation bump, you know, I think we're in big trouble. So that takes us to the bond market and what we were asking earlier. The issue that I see is foreigners have been huge buyers of bonds. They were buying bonds unhedged, uncurrency hedged. And you know, the reason they did that is obviously the US was the best economy in town. The US being the best economy in town, the dollar was, you know, pretty strong. As that happened, you made money both from the bonds and from the currency. It was a great deal for foreign investors. With the dollar doing what it's doing, that's no longer, you know, something they can do anymore. They need to, at a minimum, hedge their currency exposure. But also, they're just buying less. Foreigners are are finding bonds less appealing. When you include currency hedges, the yields are not as spectacular as they are outright. And so what ends up happening is we now have roughly almost 80% of all the issuance is being held by the private sector. So we don't have those, you know, price insensitive buyers. The Fed was one. We used to have, you know, the reserved currency managers around the world, you know, China, Europe, others, and they're just not buying anymore. So when more goes into the private sector, and you know the banks are already very full. You can see, you know, near the high, other than the last couple of years, near the highest ever percentage of their assets are in bonds, and we know that that didn't go well for them in 2023. You know what has to happen is we need a higher rate in order to incentivize buying. And so, you know, I think that this story is going to continue to play out where yields are moving higher, you know, over time to demand that. But like I said, I think the bigger story is really the dollar. You know, the dollar is down by December 2023 levels. This is the trade weighted index. And then, you know, from a valuation perspective, you know, this is the way we look at these things is you tend to have these 10-year cycles in the dollar. And so we've had a 10-year bull cycle, 10, you know, 13-year bull cycle since 2012, 2014. And, you know, then when we get a bear cycle, as you can see, you know, it tends to be return to the mean. And, you know, we could easily get 15, 20, 25% decline over time with the dollar. And so I think the dollar, you know, will have days like today where it's moderately stronger, or 2 days ago, moderately stronger. But I think, you know, the story is over the medium term, the dollar is going to be weaker. It's weaker because they want smaller current account deficits. That means we're providing less dollars to foreigners, to, you know, our trade partners to buy, you know, US assets. The US economy, you know, if we shrink the current account deficit, it also means shrinking the economy somewhat. That makes it less exceptional. All these reasons, on top of, you know, just being antagonistic, doesn't make foreigners really want to buy US assets, and they're very exposed. I think the dollar will continue to weaken, and, you know, a rapid weakening is going to create more inflation. So I think the dollar will be the constraint in that it will keep weakening until yields reach levels that incentivize buyers to come in. And so we're not seeing the foreign bid for bonds. That being said, there's a level where they will be a bid for bonds. You know, I don't know what that is, but, you know, sorry?
Yeah, that's okay. You just answered my question because I have a technical case where we get this one more low in the Dixie, Danny, towards 96-ish, 96 and a half. And if you're a bear, that completes the first wave down. That'll be 5, right? So then we're going to have a bear market rally in the dollar. But there's another count that says that's an important low in the dollar, that it's a triangle, and we're on our way back to 110 or higher. So you answered my question. Then something spectacular would have to happen with higher yields to generate that kind of dollar rally from those levels?
Yeah, in my opinion, the Fed would need to show that they're serious about inflation in
It would
order
be
for
a
that to
Fed
happen.
hike. They're not going to do
At least
that.
discuss, at least open the conversation. I don't think they need to necessarily do it, but I think they'll put if inflation is going to go to something like 5%, and the Fed is just going to say, we can deal with it, but we're going to sit on our hands and wait until it tells us that it's not transitory again. This just tells you that they don't really have strong credibility on inflation. They do have strong credibility on supporting growth. Everyone knows if we had a 5% unemployment rate next week, that they're cutting aggressively. The credibility is very strong there. On inflation, their credibility is very wishy-washy. They were aggressive in 22, but they've been basically, pretty okay with the situation since, even though consumers are not okay. They're consistently complaining about it. It drove the election. And maybe wrongfully so, because he's pursuing more inflationary policies, but it drove the election. And so I think the dollar will find a meaningful floor if they open up that distribution to rate hikes. And I think the dollar will just keep. But that being said, short term, I agree with you on the short term that we've kind of been going sideways for a few weeks now. And part of it is, excuse me, just very crowded. It's very crowded. Like this is
the dollar bear. Yeah, the bears. It's very all on one side of the boat. Similar, although not as extreme as the bears in bonds, Danny. I mean, I saw a chart where we were already at extremes in treasuries, and it's gotten even more extreme in the last month if you look at the amount of shorts in treasuries.
I don't see that in the data.
Really?
The thing is in the futures market, the speculative positioning, it is a lot of it is the basis trade, and I think we can get caught up in saying and because if you look at it, you have asset managers are long, and then you have speculative, which is hedge funds, are short, but it's like the exact same size. And so these two are just trading back and forth with each other. But when I look at surveys like the JP Morgan survey, for example, of institutional investors, it's still very net long. Nomura had a survey. Their clients are 4 out of 5 net long. So, and a lot of that is hedge funds. So I'm not seeing it in the data. And then, if you go on Twitter, I don't really see people celebrate when bonds sell off. I see people still celebrating when bonds rally. And I see comments all the time is like, when do I buy TLT? When do I buy TLT? Generational low.
Yeah.
So
you're right.
I don't see it. I see a few people here and there saying they're short. I don't see anyone who's really aggressively short. And when we sold off, on the downgrade, for example, I didn't see celebrations. I didn't see anyone saying, and that is typically what you see on Twitter. So I'm not seeing it, but I also may be missing something. It's possible, but I don't see it.
After listening to you for almost a half hour, I don't think you missed much, Danny. And I'm glad to display that to our audience today, for people that don't know you. So we're getting pretty close to a wrap. We could maybe do this. I'm interested in your view in gold, but you can tell that
I've been looking for a breakdown in gold. I've been looking for, look, I think we had a parabolic move to start the year. We had a parabolic move to start the year, which is really this move here.
Right.
As trade wars really started ramping up. And I understand it. It makes sense to say bonds are not hedging you. You need a reserve asset. And that part of the argument makes sense to me. The other arguments that we get for gold are it's an inflation hedge, or it's a hedge for risk off. Those arguments are completely bogus if you actually go and study, in the inflation surge of 21 or 22, gold did nothing. In the risk off in 22, it was down 20%, just like stocks. In the SVB, it was down 5%. In the August 2024, labor market scare, yen scare, all that,
Yeah.
down 5%, down 5%. On
Yeah.
Liberation Day, when the market was puking 6%, gold was down.
Yeah.
So these stories it tells me, from a sentiment perspective that we're creating narratives here, which tells me we're closer to the end, of it than the beginning. And then the other thing that kind of tells me that is, we have this cluster of volatility on gold, where we've had this, very huge moves, 2.5% daily moves. And if you look at the prior periods where we had these clusters of volatility, these were generational tops. So
Yeah.
2011,
2011.
generational top. Yeah,
Yeah.
generational top in 2011, 2020, generational top. 1981, major generational top. And so I see this where, we made a double top here. We have a downtrend line, but we haven't cracked. And so I've been looking for it to crack. It hasn't cracked. It's had a 10% correction. It's now bounced a little bit from that. I don't have a position, but I'm more leaning towards trying to find a, kind of 25% correction trade than I am, doing anything else. So I'm sitting on my hands until I see something tell me that's coming.
Okay, I'll let you know.
Yeah, you let me
I
know.
will. Yeah. Anyway, Danny, I really I want to thank you for coming in here, and I know you thought these numbers today you were going to have to maybe dance a little bit, but every time I second time I've talked to you now, you clear up a lot of misconceptions, even for a veteran like me that at times can buy into a narrative that's not real and actually trade off it. And so, that's why I'm following your stuff. What can people do to follow your work and your opinions? And do you write something that people could get, or should they just follow you on Twitter? Are you looking for accounts? What are you looking for in your marketing plan? What kind of?
On Twitter, I have a link in my profile for my Macro Musings newsletter, where
Okay.
every week, as well as big picture macro views, I'm putting out there, analyzing the economy, coming up with trade ideas, market views, etc. Can follow me there. I haven't made it expensive. I really just enjoy the community aspect of it, and so people can join me there. I am, starting the process of raising capital for a new fund. So if anyone institutional or accredited investors wants to get in touch, my DMs are open. Feel free to get in touch with me, and we can take it offline from there. So happy to talk with anyone who wants to chat.
All right. Really appreciate it. Here you go. Here's his monthly plan, and I think that Danny should be someone, and he's not real famous. Like a lot of guys are better at marketing than the markets, right? So this is the opposite here. Is Danny's what he markets is cutting through the bullshit and really getting to what's important in the markets. I love your stuff, Danny. I'm a fan. So
I appreciate that, Dale. Thank you so much. I'm a huge fan of yours as well. So thanks for having me on today.
we'll do it again, maybe in August. See how things are playing out.
Sounds good.
Okay.
Have a
All
good
right,
one, guys.
Danny Diane, everyone, and follow him on X at Danny Diane 5. You could join the team about 12 minutes for the morning edge, and don't just count your, I don't know, your lines on your chart. Count your blessings. Hope everyone had a decent week. See you Monday. Adios. People are thanking you, Danny. All right. See you, my trading warrior, bro.